So today we are going to start chapter 8, which is all about receivables. So a little bit of it at the beginning is kind of a review because we dealt with accounts receivable in college accounting. So we're going to talk about, kind of a refresher what receivables are. But then in this chapter, the bulk of it is really dealing with, as you probably learned in your little adaptive study plan, what happens when people don't pay. So it's, just going a little more in depth. And then we're also going to cover notes receivables, which we didn't really deal with at all in college accounting procedures. So today I'm going to use the PowerPoint kind of as a guide just to make sure I kind of cover what I wanted to cover. But we'll also be opening up the practice, chapter 8 practice in Cengage and doing some examples on some of this as we go. So that's kind of the plan. And so then next Tuesday we'll come in and just kind of pick up wherever we left off today. Because I know I can't even get through the whole PowerPoint. It's just too much information in this chapter. But a lot of it you've already read, so I don't have to go over every terminology and everything. But we'll hit what you really need to know. So hopefully that'll help some. Okay. So from college accounting again, we dealt with accounts receivable. Which accounts receivable, just as a review, what type of account is that?
Asset.
Asset, good. And so it increases, does it increase on the debit or the credit side? Debit, very good. So that's just, we got to get back into the debits and credits, which if I don't have it out there, and I'm not sure I do, I have the little debits and credits increase, decrease sheet. So I'll post that out there for you guys just to print off and have in class when you're still remembering which accounts are which, right, after the summer. So I'll throw that out there if it's not already out there. I can't remember. So now we're still dealing with accounts receivable. So when people purchase goods on account and then they owe us for them. But we're also going to deal with some other receivables as well. Okay? So we're also going to deal with, like I said, notes receivable, which is still when customers or clients owe us money. The difference with a note is that there's some type of interest attached to it. So we usually give them a longer amount of time, but then they pay us interest because we're giving them that extra time. Okay, when we dealt with accounts receivable in college accounting, a lot of times accounts receivable are net 30. They're due within 30 days, the full balance. So with a note, you can extend that out 90 days, 120 days, and even further. So just to kind of preview where we're going. I get ahead of myself. Yes.
With a notes receivable, would that be considered like credit cards with some companies?
No, those are actually different. Like credit cards will be handled as just like a cash sale, actually. So
you get that money right there. Exactly.
The credit card company itself is liable for paying us. So the credit card company pays us, and then they have to collect from the customer. So as the business, we treat credit card sales as cash. Yeah, that's a good question. Now, sometimes you'll have in-store credit. Like if you've ever, I don't know, they don't do it as much. Most places just have credit cards. But, if I go buy furniture at like Mathis Brothers, sometimes you can just open up like a Mathis Brothers credit line. And that would be kind of more like a note. Sometimes they'll do 6 months no interest or something like that. So that can be kind of similar. There's lots of different setups. But in here, a note, we're going to deal with it as just like a written promise, like a promissory note to pay. And so usually they have 60 or 90 days to pay it back, the full amount in one lump sum. Let's see, other receivables, which we won't deal with too much, but we could have interest receivable, which we will deal with on notes. But you could have taxes receivable or receivables from officers or employees that we'll get into more when we deal with payroll and stuff like that. So for the most part, in this chapter, we're going to deal with accounts receivable, again, when they don't pay, and then we're going to deal with notes receivables. So again, we know, if we offer credit, which is great, right? We offer credit to our customers because it can increase our sales, right? Oh, you don't have the cash? Well, here, we'll give it to you on a credit. And honestly, most businesses buy and sell on credit. Then they just pay it monthly at a time. So it's a pretty common practice. But we know, even when we're dealing with other businesses, not only do just people, individuals, not always pay their bills or pay them on time, companies don't always either. So it's kind of surprising, right? You'd probably be a little surprised at the percentage or the amount of companies that, default on payments or don't pay on time. But, especially in different economic times, or the smaller the company, they just may not have the funds to keep up with those payments. So what we're going to look at is what we call uncollectibles. So uncollectibles are pretty much what they state. It's a receivable amount that's due to us that we're not going to collect on. So we do have the option of, selling those uncollectible accounts. That's when you get into, maybe we've sent the person to collections, we've taken legal action, they're still not paying. So we sell those debts to a third party, and then that third party is going to try to collect on that debt. That's when you have those debt collectors that call that are with another company, and they try to collect some portion. At that point, they'll usually take a smaller amount, or they'll put you on some type of payment plan. They just try to collect something. They just want to get money out of it. So some companies have their own collections account. So if you've ever had a payment go past due and you called, they may say, oh, well, let me put you with our collections account. So they have a dedicated account that calls customers, harassing. Give us our money. So it just depends on the size and the structure of the company, how they handle those things. So yeah, it doesn't matter, how many credit checks we do or what we do, thank you, to try to prevent this from happening, but every company deals with uncollectibles. Okay, it's just part of life. It happens to companies, it happens to people where you fall on a hard time and you may not be able to pay, and you've always had a perfect payment history. These aren't always predictable behaviors. They might run a credit check, run your credit score, see where you're at, and that's usually a good prediction of behavior, but we can't predict everything. What if a company goes bankrupt? Or a person, maybe it's a small person, a small business or something, one business owner. What if they have to file bankruptcy due to illness or something else? There's lots of factors there. So we just have to kind of account for the fact that we're going to have some amount of money that we're never going to see. And so we call that bad debt expense. So that's the account that we use. And bad debt expense is just like a normal expense account. So a normal expense account, what side does it increase on? It's not a liability, it's actually under equity, if you remember. It's actually an equity account. It's been a while already.
The other one was liability. The other class it was liability and assets.
Yeah, assets equal liabilities plus equity. And so expenses actually fall under equities, under like stockholder equity, if you remember, but they decrease. Remember, expenses decrease stockholders' equity. So they actually increase on the debit side. Okay. Some nice reviews, right? So if you remember, yeah, our basic accounting equation is assets equal liabilities plus stockholders' equity. So expenses decrease equity. Equity is the money we have. If we took all the assets in our company and paid off all of our liabilities or all of our debts, equity is what's left over. Okay? So it's kind of like, you can think of equity as like the net worth of the company. So anytime we have to pay an expense, that's coming out of that, what we have, our net worth. Okay, so bad debt expense is just like any other expense account, like rent expense or supplies expense or anything like that. So it's going to increase with the debit. So it's an expense of doing business, basically, that we have these accounts that will go uncollectible. I think we already talked about that. So when we're dealing with these uncollectible receivables, there's two methods that we can use to deal with them. We have the direct write-off method, when we literally look at a company and say, you know what, they're not going to pay. And we just write off that account. to bad debt expense. So we just expense it out, okay? That's often used by small companies or companies with few receivables. A lot of times it's used with companies that use like the cash method. Instead of, we're going to focus still in this class on the more corporate accounting procedures. So we do the accrual method of accounting. If you remember, these are good reviews, right? Back in chapter 1, no, seriously though, we had like the revenue recognition and the matching principle. If you remember, those both stated that if we earned revenue in a period, we had to recognize it in that period. So whether the customer was paying us in this period or not, if we provided goods or services, we're going to recognize that revenue in the period in which it was earned. Same with expenses. If we incurred an expense, we're going to recognize that expense when it happened, not when we pay for the expense. So those were some of our accounting principles that we dealt with in college accounting. So the direct write-off method is really easy. You literally just find the accounts that you don't think are going to pay and you clear off their accounts receivable. But the caveat of that is we cannot use it if we're a corporate into corporate accounting. So if we're a publicly traded corporation, we have to follow GAAP, right? The generally accepted accounting principles. The direct write-off method does not follow GAAP. And we'll talk about that here in a minute. So if we're a publicly traded corporation and we have to follow GAAP procedures, we have to use what's called the allowance method, okay? And we're going to look at these two methods and then kind of do some examples. So again, the difference is with the direct write-off method, we're literally going through our accounts receivable and saying this person's not going to pay, this person's not going to pay. And we're not just doing that randomly. Like, eeny, meeny, miny, moe. We're looking at how old the account is. Do we call their phone number and it's busy, like it's, they've disconnected their phone? Yeah, those kinds of things. So we have some standards that we look at. If they filed bankruptcy, if it's been past 90 days, if we can't get in touch with them, they're not answering or returning our phone calls. Those are probably all good indicators that we're not going to see any money. So those are the things that prompt us, and every company has their own, guidelines for how they determine when an account is uncollectible. The allowance method, we're not looking at account by account every year. What we're doing is we're looking at the end of the year. You remember adjustments that we did in chapter 3 that everyone loves so much? It's an adjusting entry. So what we do is at the end of the year, we'll assume the fiscal year runs January through December. So at the end of December, we look at all of our accounts receivable and we use some type of allowance method, which we'll talk about, and estimate of those accounts receivable or of those credit sales, how much is uncollectible for that whole year, okay? So it's an estimation. And how that works with the allowance method, why it follows GAAP, is we're saying in the given year, in the current period, which is important in accounting, right? We need to do things in the current period. Out of all the, credit sales or all the accounts receivable we've had, we're saying this much of that is uncollectible. So it follows that matching principle and that we're recognizing the expense in the year that it's actually been incurred, okay? Because what happens is, this is where it gets a little confusing. This is probably the most confusing thing in chapter 8. And I'm probably getting ahead of myself, but we'll reiterate it. The thing is, if we were to say we sell something in July, we sell to a customer in July, we bill them, they don't pay us. If we don't do anything with that until next year, which may be the case, right? We may wait until next January. It's been 6 months. They're never going to pay. We write off the account. Well, we recognize that revenue in 2019, and now we're writing off that expense in 2020. Does that match the period in which we earn the revenue? No. So that's really what it all boils down to. That's why if we are a publicly traded corporation, we have to do the allowance method because we need to estimate in the period in which we earn the revenue, what's the expense that might be associated with that. Okay. So again, we'll practice that a lot. But it's just really important. So it is an estimation. We can't, look into a crystal ball and determine exactly how much it's going to be uncollectible. But we have ways that we can make an estimation. So you'll find, in college accounting, we dealt with pretty much absolutes, right? We absolutely did this, debit, credit. Financial accounting, there's a little more interpretation. We really get into, there is some estimations in accounting. And we do our best. It's not a guess. It's truly, we try to look at past trends and what's happening and look at those things and make a good estimation.
Quick question about
Sure.
direct write-off. It almost seems like it might be easier to commit fraud with that.
That it would have what?
They should be able to do more fraud with direct write-off with small businesses since you can't do the matching principle.
Small businesses, since they use cash method, it's just a completely different game because they're usually not even recognizing revenue until they receive it, still until they get paid for it. So the direct write-off method actually matches up to that, if that makes sense. Honestly, in any given situation, you're going to have the ability to have a fraudulent situation in either accounting method. But that's part of why direct write-off method is not GAAP compliant. It really works better for very small companies that are cash only, cash basis accounting, because it's easier to track when you only have maybe 10 customers or 20 or 50, whatever the smallness is. So, if they're doing their proper auditing and reporting, then it's okay. But yeah, unfortunately, we do see a lot of fraud in small businesses though, just because there's less regulation. So unfortunately, it just hurts the business owner though, generally.
True.
So we're still going to look at the direct write-off method. We're still going to learn it. It's pretty easy though. As you can see, when we're doing it, when we determine that an account is uncollectible, and we're assuming at this point that we are a small business owner and we use cash basis accounting, we just debit bad debt expense and we credit accounts receivable for that customer. So you'll notice this is a little different. When we dealt with accounts receivable in college accounting, well, I guess we did at the end when we were dealing with sales, we're going to start attaching that name. So that's very important because we're tracking sales by person. I guess we did when we got into like merchandising. It's been a while, right? So we're going to write off their specific account. So on May 10th, we determined DL Ross is not going to pay. So we debit bad debt expense and credit accounts receivable DL Ross. That doesn't mean we're not still going to try to collect on that account. We may still sell it to a third party, or or we may still push collections. We can still take his money or her money. We're just trying to, again, estimate as best we can how much we don't think is going to be collectible. And this is really important too, that we do this, whether we're cash basis or accrual basis, that we account for uncollectibles, because it does affect our end statements. If we left everything in accounts receivable, well, our revenue is going to be overstated and our assets are going to be overstated. Because we're saying, oh, all this money is kind of come in and we earned all of this money. But when we start writing off accounts, assets are going down because we're saying, well, they're not going to pay, so we're taking them out of accounts receivable. And revenues are going down because expenses decrease revenues. So we have a more accurate depiction of our income, okay? So that's kind of why this is so important, because when we overstate assets or we overstate income, we're basically misleading our investors and our creditors, and we might be able to get this great big loan that we can't pay off because we're like, oh, we made $5 million, but did we really? So just because we write off an account doesn't mean we can't receive payment on it later. So if this DL Ross comes back and says, we've now called them and called them and called them, and finally DL Ross is like, oh, here's your money, or a portion of the money. That's fine, we'll take their money. We're accountants, right? So what we do is we just reverse that entry. We wrote it off to bad debt and we credited off their account. We're truly just going to flip that entry and restate it, and then we're going to receive the payment. So DL Ross paid us on November 21st. maybe, hit D.L. Ross's credit report, and he's like, okay, I need to take care of this. So we reinstate it. We debit accounts receivable and we credit bad debt expense. So that gets reversed. And then on the second entry, we're receiving the cash and crediting their account to show it's now been paid. I know you think, okay, why can't we just debit cash and credit bad debt expense, right? Just save that entry. But then you'd have no record. Where did that cash come from? So we do it like this to make sure we see, okay, D.L. Ross sent us a check. So we reinstated his account and then we show it as being credited or paid off. It's just important, obviously, in accounting that we keep really good records. And so we don't just have this cash flowing in and, who did it? Where did it come from? Got mailed $4,200. That'd be nice. Any questions on that one so far?
Pretty simple.
Do it.
Pretty simple.
Pretty simple. Yeah, direct write-off is really, really easy. So while we're on that direct write-off, I think we'll just log into your Cengage and we'll go into the Chapter 8 practice.
The practice I'm showing is locked until 29.
I'm getting ahead of myself. It's like causing issues. I'm going to open that practice up.
Hindsight though, practice 14 is locked until 26, but the exam's on the 21st.
I'll go ahead and play with those dates. It always shifts all my dates when I copy things over from one semester to the next. And I changed all the assignment dates, but I obviously didn't change the actual. Okay, you should be able to get in now. So the Chapter 8 practice, so you may have to reload it, click back on it. Okay. And it just should say Chapter 8 practice. So you should be able to find it on Canvas. I just got it where you can open it. So on Canvas, if you go under Unit 1, you should see a link to Chapter 8 practice. So yeah, make sure you're on the Chapter 8 practice. So it's probably easiest to go through Canvas because sometimes they're kind of harder to find on Cengage if you just log into Cengage. Can I ask you a question? Sure.
It's pertaining to this in a cage.
Okay. Okay. Did you say after class? After, yeah. I thought I heard that. We can talk right now. Did everyone find it?
No.
Who said no? She's really right. All changed. Yeah. Yeah, it'd be much easier.
Almost like last week. This week's stuff was- Physical philosophy, and also stats. I said press one with a tip method.
Yeah, I can.
Straight up just has such assignments.
I know, you're fine.
Quizzes. for exams.
I'm
So, yeah.
not all of it. It's not, okay. Stressing out. I'm worried. Yeah, I think I'm gonna go ahead and one that's, we don't need to make it easy as possible.
Okay, so this first one that we're dealing with is just dealing with the direct write-off method. So it's just what we just talked about. So we're going to, jump right into journal entries, right? So it says journalize the following transactions for Canyon River Medical Company. They use the direct write-off method for uncollectible receivables. So again, they're not GAAP compliant. They're not a publicly traded corporation. So they can use the direct write-off method. Well, if you notice, this first journal entry on the January 19th is actually a review from college accounting. So it's selling merchandise on account. So it says on the 19th, we sold merchandise on account to Dr. Kyle Norby for $6,400. And the cost of goods sold was $3,000. So as you can see, if you remember, there's 2 journal entries every time we make a sale on account. So does anyone remember first recognizing the sale? What do we debit and credit when we sell goods on account?
Accounts receivable and sale.
Very good. Yeah, we debit accounts receivable, in this case for Kyle Norby. So I'm going to debit accounts receivable, Dr. Kyle Norby, and credit sales. And that's $6,400. Okay. $6,400. And then the second journal entry, it says cost. We need to recognize the cost we paid, right? Because the goods that we sold we no longer have. So we need to expense those out. So what do we debit and credit to recognize the cost?
Cost of goods sold to inventory.
It's cost of goods sold and inventory. Yeah. So we actually are going to debit cost of goods sold. Because remember, that's the price we paid for the merchandise. So that's $3,000. And we're going to credit inventory. So cost of goods sold is the expense account where it's showing, well, it cost us $3,000 to purchase these goods, right? So $3,000 is the cost to us. And then the inventory gets credited. If you remember, inventory is an asset account that increases on the debit side. When we credit it, that shows the inventory is gone. We no longer have that asset. So it's moving out the door. So good old reviews, right? Didn't know you'd be using so much of what you'd already learned. Like, oh no, I have to remember all that. So now that's just a review of how we do sales on account. On June 2nd, we received $500 from Dr. Kyle Norby, and we wrote off the remainder owed as uncollectible. So that one's, a little more complicated, right? Well, what do we do with the $500 that he paid us? We debit cash. Very good. That one's pretty easy, right? So we receive cash. It's an asset. Increases with the debit. Well, if he owed us $6,400, he paid us $500, and the rest we're thinking he's never going to pay us the rest, right? So what do we do with that remaining $5,900?
Bad debt. We debit bad debt expense.
Very good.
Credit accounts receivable.
Perfect. Yeah, we're going to debit bad debt expense for the $5,900 that remains on his account. And we think we're never going to see that. We just write it off directly to bad debt expense. And then we credit the total amount to accounts receivable, Dr. Kyle Norby. The $500 he paid, the rest we wrote off directly. So his whole account gets credited to $6,400. And then our journal entry is balanced, right? Our total debits equal our total credit. So we're good. We're happy. Okay. So yeah, direct write-off is pretty easy, right? You're just truly writing off the amount to bad debt expense. Okay. On October 23rd, it said we reinstated his account that had been written off and received $5,900 cash in full payment. So, it's been 6 months or 4 months, however long, like 4 months, I guess, 4.5 months. And now he's paid this account. Okay. Well, the first journal entry says reinstate. So what would I do to reinstate what he owes us?
You would,
Accounts receivable, very good. I debit accounts receivable.
So why are we debiting accounts receivable?
We're saying, now that he's paying, we're going to reinstate his account. So we're going to say, okay, he's paying, so we're going to put that money back in his account, so then we can credit it, showing that it's been paid.
Okay, I see.
So it's just like
why are
kind
we
of a
debiting
reversal.
that?
Yeah,
The word kind of credit.
yes, yeah, we're going to credit it too. It is a little
It
confusing.
makes sense though.
Okay, cool. And then what do I credit? Perfect. So I'm going to credit bad debt expense. So you're truly just flipping that entry, and it's for the $5,900 because he already paid $500 of it. So we're just reversing the entry. It's truly just a reverse entry there. And then on the second entry, when we collect, what would I debit and credit?
cash accounts receivable.
Perfect. You got it. So cash gets debited and accounts receivable gets credited for the $5,900. Make sense? That one's not too bad. Now we're going to switch back and talk about the allowance method, and then I think we should have time today to do some examples on that. And then, like I said, Tuesday, we'll really just need to wrap up like the chapter doing notes receivable, and then we'll have some time. We might do some small group extra practice, or maybe work on homework, where you guys can kind of practice this a little bit more, kind of see what we want to do, right? We have a big class though, so small groups might be a little bit easier. Any questions on that one? You can always just check my work to make sure we did it correctly. I print the answers and bring them just to make sure, You never know. I'm going to switch back to the PowerPoint.